If the idea of getting paid to wait makes your shoulders drop a little, you already understand the appeal of dividends. There's something deeply satisfying about cash showing up in your account because you own a slice of a business, not because you sold anything or worked another hour. But dividend income is not magic, and it's not a screenshot you chase with the highest number you can find. It's a calm, repeatable way to let the world's businesses share profits with you, if you understand the mechanics, respect the math, and build a simple system you can keep when life is loud. This is your long, beginner-friendly tour of dividend income, what it really is, how it's paid, how to evaluate it, how to build a portfolio that uses it wisely, and how to avoid the traps that trip up smart people. Start by stripping the romance out of the word. A dividend is a cash distribution from a company or fund to its owners. That cash is not free. It comes from profits, or in some cases from selling assets or using balance sheet cash. Some companies also issue stock dividends, more shares instead of cash, or special one-time payouts when a business sells something big or is unusually profitable. Most of the time, though, we're talking about straightforward cash that lands in your brokerage account on a schedule. The board of directors declares an amount per share, sets key dates, and a few weeks later you get paid your slice. If you own a fund rather than individual companies, the fund passes through the dividends it collects from its own holdings, and you receive a distribution based on how many fund shares you hold. The calendar around dividends matters more than any single headline yield. 3 dates run the show. The declaration date is when a company announces how much it will pay and when. The record date is when you must be on the company's books as a shareholder to be entitled to that payment. The ex-dividend date is the crucial cutoff. Buy on or after that date and you won't receive the upcoming dividend. Sell before it and you forfeit the payment. The payment date is when the cash actually arrives. On the morning of the ex-dividend date, the stock price typically adjusts down by roughly the amount of the dividend because the cash leaving the company reduces its value by that amount. That tiny drop is a reminder that dividends are not a free lunch. They are a way of receiving a portion of your return in cash rather than waiting for price appreciation. Yield is the number that gets attention because it seems to answer the question, how much do I get? A 5% yield means the annualized sum of payments over the last year equals 5% of today's price. But yield alone is a terrible compass. The calculation uses 2 inputs that move. Payments can change, and so can price. If price falls because the business is weakening, the yield rises and tempts you, exactly when future payments may be at risk. If a company raises its dividend every year, a current yield that looks modest may turn into a much larger yield on your original cost years from now. Learn to treat yield as a clue, not a verdict. A useful way to think about income is forward yield, based on the next announced payment annualized, paired with an honest reading of the company's ability to keep paying and growing that payment through a full business cycle. Payout ratio is a sturdier anchor because it connects payments to profits. In its simple form, payout ratio is dividends per share divided by earnings per share. A company that earns $2 a share and pays $1 is sending half its profits back to owners and keeping half to reinvest, reduce debt, or buy back shares. The right payout ratio is not a universal number. It depends on the industry. Utilities and consumer staples can sustain higher payout ratios because their earnings are stable. Cyclical or capital-intensive businesses need more cushion. A safer version of this test uses free cash flow, the cash left after running the business and investing in maintenance, rather than accounting earnings. People who fall in love with eye-popping yields often skip this test and learn a painful lesson when a payout that never should have been that high gets cut to something survivable. Dividend growth is the quiet superpower of income investing. A company that raises its dividend a few % every year is giving you a raise without a negotiation. That raise helps your income keep pace with inflation, signals management's confidence, and usually reflects a business model with durable cash generation. Some investors organize portfolios around companies with multi-year streaks of increases. That can be helpful shorthand, but streaks are not guarantees. What you really want is a business with returns on capital above its cost of capital. a long runway to reinvest intelligently, conservative debt, and a management team that treats the dividend as a commitment rather than a marketing tool. If that sounds abstract, translate it to a simple question. Is this company built to keep paying me more 5 and 10 years from now without starving its future? Total return is the big picture you should keep in view. Dividends are one part of your return. The other is price change. Focusing on the check while ignoring whether the underlying business is compounding can lead you to celebrate 5% cash while losing 10% in value. The healthiest way to think about dividend investing is as a way of shaping the character of your portfolio's returns, not as a separate religion. Dividends can make returns feel smoother, encourage a buy-and-hold habit because you have something to collect while you wait, and provide cash you can redeploy without selling shares. But the best dividend portfolios still care about growth, profitability, and balance sheet strength, because those are what support dividends in the first place. Taxes matter because they change the net you actually keep. Details vary by country, but many systems distinguish between certain kinds of dividends that get favorable rates and others taxed as ordinary income. Distributions from certain real estate companies and partnerships can have special treatment. Funds may pass through a mix. The point isn't to memorize rules, but to remember that dividend yield is a pre-tax number. Holding assets in the right type of account for your jurisdiction and goals can be the difference between a strategy that feels generous and one that feels sluggish. A simple habit, keeping higher yield, tax-inefficient holdings in tax-advantaged accounts when possible, and letting broadly diversified equity exposure live in taxable accounts, often improves outcomes. When in doubt, a short conversation with a tax professional beats heroic guessing. Not all dividend payers are created equal. A bank with a strong capital position and conservative underwriting can be a sturdy payer. A bank chasing growth with thin reserves may look generous right until it isn't. A utility with regulated returns and predictable demand can keep a high payout ratio safely. A commodity producer swings with prices it cannot control. A technology company might pay a small dividend and complement it with buybacks that retire shares over time, quietly increasing your claim on future profits, even if the cash distributions are modest. A real estate trust might pay a chunky distribution because the law requires it to pass through most of its taxable income. Each of these categories pays for different reasons and with different risks. The beginner's edge is humility, learning why a dividend exists before falling in love with its size. Funds can be a beginner's friend because they apply rules across many companies and remove single company risk. An index fund focused on dividend payers spreads your bet across hundreds of businesses that meet certain criteria. Some funds emphasize high current yield, others emphasize quality and consistent growth of dividends. The latter tends to be a gentler ride across cycles because it avoids companies that grab attention with unsustainably high payouts. Funds also handle the dull work for you, rebalancing, removing companies that cut dividends, reinvesting distributions if you choose. The trade-off is that you accept the fund's rules and fees. As a beginner, that trade-off is often worth it because it keeps you out of the game of chasing individual yields before you can read a balance sheet confidently. There is a rhythm to building dividend income that feels humane rather than heroic. Start by automating contributions on payday into a diversified core that includes dividend exposure. If you need the cash, instruct the brokerage to pay dividends out to your checking. If you're still in accumulation, turn on automatic reinvestment so every distribution buys more of what paid you next time, compounding the number of shares that will pay you next time. Reinvesting is not glamorous, it's powerful. Your share count climbs in the background, and future payments rise without you lifting a finger. At some point, you might want to tilt towards individual companies. Do it slowly and with a notebook. Pick one sector you understand because you use its products and follow one or two companies through a full cycle. Read their annual reports with a highlighter. Learn how cash moves through the business, what the capital allocation priorities are, and how management talks about the dividend. Track the payout ratio over several years, debt levels, interest coverage, and whether free cash flow is growing.
Watch what they do during stress. Some companies hold the line on dividends, others trim to protect the future, and a few heroically raise the dividend during tough times to signal strength. The exercise isn't about proving you're a picker, it's about learning what a sturdy payer looks like from the inside, so your later choices become calmer.
Beware the classic traps. The first is chasing the highest yield on the page. Extremely high yields are often the result of a falling stock price rather than a generous business. The number is signaling stress. A disciplined investor asks why the yield is high and what must be true for it to be sustained. The second trap is concentrating in sectors that pay well during certain interest rate environments and then struggle when those environments change. The third trap is ignoring the balance sheet. Dividends compete with debt payments. When financing costs rise or cash dries up, something gives. The fourth trap is confusing distribution frequency with quality. Monthly payers feel nice, quarterly payers are the global norm. Frequency has little to do with safety. The fifth trap is forgetting that the dividend is set by the board. It is a policy choice, not a natural law. Policies change when reality does. Yield on cost is a phrase that wins hearts and muddles thinking. It measures today's annual dividend against your original purchase price, which can be satisfying if you bought years ago and the company has raised its payout. It is a useful way to feel the effect of growth, but it is not a useful way to make new decisions. Future choices should be made on forward yield and forward growth prospects, not on the nostalgia of what you paid long ago. Treat yield on cost like a smile, not a steering wheel. If you plan to live on dividends later, start thinking in terms of income design rather than target numbers copied from someone else's portfolio. Imagine the bills you want the portfolio to cover: housing, food, insurance, small joys, and decide which parts you prefer to pay with contractual income and which parts can float with market returns. A mix of broad equity funds for growth and rising income, bond ladders for predictability, and dividend-focused funds or companies you trust can produce a cash flow that covers most months. The trick is sizing and patience. Building the income engine takes years. You don't need to arrive tomorrow. You need to keep contributing and avoid mistakes that force you to sell at bad prices. Let's make this practical with a 12-month beginner plan told as a story rather than a checklist. In your first month, you open a brokerage account if you don't have one and connect it to the checking account where your paycheck lands. You name a small automatic transfer that leaves on payday and goes into a broad equity index fund and a dividend-focused fund. You pick distribution handling based on your stage, reinvest if you're growing, pay out if you need the cash for an explicit purpose. You promise yourself you'll ignore daily price moves and revisit your setup on your birthday and halfway to your next birthday. Through the first quarter, you let the automation do the lifting while you read. You learn what ex-dividend dates are and why the price tick matters. You watch the first small distribution appear and practice doing nothing dramatic. You notice how funds report their distributions, and you start to understand that some months pay more because more companies pay them. You also notice that dividends are uneven and that building a smooth monthly paycheck from dividends alone is less realistic than building a steady annual income that you manage with a cash guffer. In the second quarter, you get curious about one dividend growth company you use every week. You read 2 years of shareholder letters, you write a paragraph in plain language about why the business earns above average returns on capital and how it treats owners. You buy a small position and set your expectations appropriately. You remind yourself that as a beginner, you will be wrong sometimes, and that being wrong small is the tuition you pay for getting good later. You keep your core fund contributions steady, so one idea never dominates your month. In the third quarter, you examine your appetite for income today versus income later. If you're close to needing income, you decide whether a small bond ladder would make your cash flow calmer. If you're far from needing income, you stay heavy on equity funds and let dividends reinvest. Either way, you organize your financial life so that bills are paid by salary and cash reserves, not by selling investments in a panic. Dividends then become a pleasant addition rather than a necessity that forces bad timing.
In the fourth quarter, you review your year and write a one-page policy you can follow next year without drama. It says what you own, why you own it, how much you contribute on payday, how distributions are handled, and when you will reconsider. It includes a sentence about how you'll behave during a market drop. You will keep contributing, you will not chase yield to replace price declines, and you will remember that the healthiest dividend payers tend to keep paying through the noise. You print the page or tape it in a notes app where you'll actually see it, then you go to bed. Policies beat moods. There are special cases worth understanding even if you avoid them at first. Real estate investment REITs pay attractive distributions because the law requires them to pass through most of their taxable income. Their payout ratios look high because their accounting differs from other companies. They're often tax inefficient in some jurisdictions, which means they may fit better in certain account types. Master limited partnerships can pay handsomely, but come with complex tax documents and rules that make them a poor fit for beginners without guidance. Covered call funds generate income by selling options on the holdings they own. That income can be appealing, but often comes at the cost of upside in strong markets and with distributions that vary. None of these are forbidden, they are simply advanced tools you should only use when you understand what you're trading for the income you see. International dividend investing adds another layer. Companies outside your home country may pay on different schedules, in different amounts across the year, and subject to withholding taxes that you can sometimes recover or credit, depending on treaties and account types. Currency moves can amplify or dampen the cash you receive in your home currency. The benefit is diversification, the cost is complexity. As a beginner, an international dividend fund can give you exposure without paperwork surprises while you learn. Dividend reinvestment plans, often called DRIPs, are mechanical and underrated. By instructing your broker to reinvest dividends automatically, you convert each payment into more shares without thinking about it. Over years, that habit turns a modest income stream into a growing one. If you prefer control, you can instruct dividends to be paid in cash, and then deploy that cash consciously into whatever is most attractive at the time. Both approaches can work. The key is having a rule and following it, not reinventing the system each month based on whatever you saw online that week. Psychology is where dividend investing quietly helps. Many people find it easier to hold through volatility when they can point to checks that still arrive. That steadiness isn't just emotional comfort, it's better behavior. Selling in fear and buying back later is the most expensive habit in investing. Dividends can be the anchor that keeps you aboard long enough to let compounding do its work. The anchor is not indifference to price. It's a reminder that you're an owner, not a trader of tickets. At some point, you'll hear a debate about whether dividends are superior to buybacks. The grown-up answer is that both are tools, and the right tool depends on the business and the moment. Buybacks reduce the number of shares outstanding, increasing your claim on future earnings without sending you cash today. If a company buys back when they're undervalued and stops when they're expensive, buybacks can be efficient. If a company buys back regardless of price, buybacks can destroy value. Dividends are a promise in cash. Buybacks are a promise in arithmetic. As a beginner, you don't need to choose a religion. You need to prefer companies that allocate capital rationally and treat owners as partners. A word about sustainability through cycles. The best dividend payers build flexibility into their policies. They target a payout ratio that leaves room for reinvestment and for margin of safety. They hold cash or credit lines that let them bridge rough patches without cutting dividends. They prioritize the dividend alongside growth projects rather than instead of them. When conditions change, they communicate early and adjust deliberately. When you evaluate payers, look for the signs of that culture. Consistency is not an accident. It is a set of choices repeated over years. It's helpful to set expectations about income amounts. If your portfolio yields 3% and you own $100,000, your annual gross income is roughly $3,000 before taxes. If you contribute steadily and the companies you own grow their payouts, that number will climb. But the latter is built with paychecks and patience, not with heroic stock picking. Beginners often underestimate how long it takes to convert capital into income. That underestimation leads to chasing. You are better served by contributing more, letting your core compound, and letting dividend growth do what it does, quietly. Risk management for dividend investors includes the boring things that protect any plan. Keep a cash buffer so you never need to sell a holding in a down market just to fund groceries. Diversify by sector and geography so one industry's bad year doesn't become your household's bad year. Keep position sizes sane. A beloved payer can still shock you. Review once or twice a year, not every day. If a company cuts its dividend, revisit the thesis with clear eyes. Sometimes a cut is a wise reset that makes the business healthier. Sometimes it signals deeper issues. Either way, your policy will tell you what to do next, so emotions don't write the check. Stories can make the mechanics feel real. Picture a teacher in her early 30s who starts with a broad equity fund and a dividend growth fund, contributing a fixed amount every payday. She turns on reinvestment and doesn't touch anything for a year. The next year, she adds a small position in a consumer staples company that has raised its dividend annually for decades. She keeps reading and resists the urge to add the high-yield energy stock her coworker won't stop texting about. 5 years later, her portfolio's cash income has doubled without her ever chasing yield, and her share count has climbed so that each raise the companies give themselves shows up as a raise in her mailbox. She didn't become a market savant.